Right now, people all over the world are scared. Trump and his tariffs got the market shaking, and a lot of investors are watching their portfolios drop fast. But here's the thing, you don't have to be one of them. In fact, if you follow what I'm about to show you in this video, you could actually come out way ahead, like hundreds of thousands, maybe even millions in profit over the next few years. Now, that might sound wild, but it's not. Once you know what to do, it's actually way simpler than most people think. First thing first, if you haven't already, you need to start investing into high quality stocks. But what even is a high quality stock? Well, for me, it comes down to three main things. First, the company has to be in a big or growing sector, because if we're putting money into a company that's in a dead or boring industry, we can't expect much growth from it either. But there's an exception. If that company is actually innovating or doing something new that sets it apart, it can still grow big, even in a slow moving space. Second, the company needs to have a strong edge or moat, meaning something that gives it an advantage and keeps competitors away. That's how it survives and thrives long term. Third, the financials gotta be solid. If the company is drowning in debt, barely making any profits, and not using its capital well, then it's probably not going to make it far. So we want businesses that are efficient, profitable, and built to last. The second step to actually making money from this crash is simple. Don't sell your high quality stocks just because they're down. If you've got conviction, which basically means you believe in your investment and you've done the research to back it up, then you need to stay with it. The worst thing you can do is panic sell just because a stock dropped. And of course, it sucks to see red days, but if the company is solid and nothing has changed fundamentally, then selling now just locks in your loss. But if you hold on to those quality stocks and you're thinking long term, like 5 to 10 years, there's a good chance they'll bounce back and even grow way past your original investment. But to really boost those returns even more, that's where step 3 comes in. The first step is to dollar cost average when your stock drop. This just means buying more of the stock as it falls, and the reason we do that is simple. We want to lower our average price and get in at a discount. But here's the key, you only do this when you've got conviction in the stock. If you've done the research and believe in the company long term, then buying during the dips makes total sense. Now, people always ask me, how often should I buy? And honestly, it depends. What I usually do is this: if one of my stocks is down 5 to 10%, I'll buy in with around a quarter of my starting position. If it keeps falling another 5 to 10%, I'll add another quarter. And sometimes, if I had a stock that was up like 20% and it suddenly drops back to break even, I'll buy more there too, just to build a bigger position if I've got the extra capital. Now, this gets tough if you're managing 20 or more stocks, which is why I personally don't like over diversifying. If I've already picked a stock for my portfolio, it's probably high quality, so why not go big, especially if the upside is massive? The fourth step, and this one can actually set you apart from the crowd, is to keep searching for quality stocks. Now, yeah, this might sound obvious to some of you, but a lot of people get lazy once they've built a portfolio. The truth is, if you're not consistently on the lookout for undervalued or overlooked companies, you could miss out on some huge opportunities, especially during a crash like this. That doesn't mean you should chase every dip or get caught up in FOMO, it just means staying open minded. Keep doing your research, stay curious, and be ready to move when something great shows up. The last and final step is to control your emotions. Now, I know this might sound a bit boring or overused, but this is one of the most important things when investing, especially during a market crash. Because even if you've done everything right, if you let your emotions take over, you could end up messing up your whole plan. You see, most people lose money not because they pick bad stocks, but because they panic sell when things go down, or they chase hype when things are going up. And that's exactly what we don't want to do. So, what should you do instead? First of all, trust your research. If you've built conviction in your stocks, then don't let some red day shake you out of your positions. Second, try not to listen too much to the news or social media during crashes. They often just make you more scared or confused. And third, remind yourself why you bought the stock in the first place and what your plan is. If nothing has changed with the company, then maybe the drop is just a noise. Because at the end of the day, investing is a long game. And if you can stay calm when others are freaking out, then you're already ahead of 90% of people. But you can't really do any of this without solid and trusted data. And that's exactly where the sponsor of this video, EODHD, comes in. They give you access to high quality API keys packed with all the data you need for investing, from fundamentals to historical prices, earnings, and way more. So if you're serious about taking your investing to the next level, definitely check them out. Now, with that said, I hope this video gave you some real value and helped you understand how to actually profit during a market crash instead of panicking like most people. But if you want to go even deeper into how to find the right stocks, then make sure to watch this video right here.